All right, guys, middle of the week. We're going to get the phase one details coming shortly, so I want to make this a short highlight. We opened the day about 7, 8 points below where we closed yesterday, and we had this weak move to retrace. I thought early on this could just be the retracement for downside, but once it got too high and it did this, started moving up, it's like, hey, they took back all of that move from that circle, it's bullish, and the best first place to buy a retracement, unless you were bullish in here, there were some pullbacks, but was this guy. And why this guy? I'll show you in a second on a footprint chart where it showed that there was some good, a thin spot or the market turned around and came up and it just snuck below it and then continued its upside. But what I was telling people throughout this whole rally was be careful fading it. Be careful trying to get short. A lot of times you get short because you missed maybe the long from down there to up here, and your mind tries to get you to do the opposite. When it missed a rally, it tries to get you short to catch the break, and you start picking a top for no other reason than you missed a trade, and the market doesn't care that you missed a trade. You're not being objective in that respect. So my first job in moderating this room is to keep people off the wrong side and give them a better chance to get on the right side. So the first chance we had for a market to come down was right in here, and I'm going to replay it, and I want to show you the speed, and I'm going to replay this right now, the speed in which they jump up, they make higher highs in this sequence, all-time highs, but also day session highs. They jump them to 96 or 97, I believe the price was, and what's important to note is how quickly they went up and then came back down. And that's when I said, when it was trading 95.75, that that's rejection. When the tempo picks up like that, goes up, comes back down, that's generally a high probability rejection. And the story I tell is that when you're trying to hit on a girl when you were single and she slapped you in the face and the tempo picked up, you knew she rejected you. You knew what was next. All right. And so the best chance to fade it, to take a short on an uptrend, is let the trade find you. Let the rejection happen. Now I'll pause it. And early on, like right around in here, in real time and in the room, that was the best chance for some continuation to the downside. I'll replay it or play it again, and you can see it leak all the way back down to some lower levels. What's really important about trading is let trades find you, especially when you're taking a contrarian approach. And there's nothing wrong with fading markets, and there's nothing wrong with picking highs and trying to pick lows. There's a difference between fading and fighting. And fighting is when you're just trying to fade it for reasons that are emotional, for reasons because you missed it, and no objectivity, no real skill set, no real good relationship, no real trade find you type of setting. So it's like, this isn't a good guess. I don't feel proud when I make good calls or good trades. That's part of what you're supposed to do. And you're supposed to have and you're also supposed to be wrong, just not wrong for long. Now, there was another instance that I want to talk about, but this thing might not reload in time, and maybe it will. And it was a head fake off the highs, which showed another near-term top, and that was right in here. So before, I'm not going to replay it in real time, but I'll go back a little bit. Right in here, you've seen the market scoot up through the highs and then come right back down pretty quick through the middle. I was actually not looking at it, came back at 96.5 instead of 97.25. I told guys the bottom of this is in trouble, and the downside's the right side near term. All right. Then I thought that this 94 even area was going to be resistance, but there was no qualifier to get short. And it wasn't a god-awful price because it just went sideways, right? Sideways. The bottom of here, once that's in trouble, the bears take over. But the top, once that is in trouble, or once that get closer to that, the shorts are in trouble. Closer to the bottom, the longs are in trouble, and you're just cognizant of that. And so they ended up leaving the top of the box. So that's why the middle of consolidation is so important. And if you watched any of the videos that I've done, that's 5 video series I did a couple weeks ago to start the year. The first one is following a market in rotation like a bird in the sky if it left a trail. And the second part of that webinar was consolidation boxes. If you're not viewing the market in their boxes, then you're not going to see where the fights are. And tell me anybody else that's out there talking about that stuff. What's basic to me needs to be basic to everybody else. And most people don't search for the why. They just look for the how. How is irrelevant. If you know why, you got a better chance at implementing the how and the when. So good luck. If you're watching this pretty close to real time, some phase one details might be coming out. Be careful.